Ever wonder how billionaires manage to accumulate vast fortunes and yet seemingly pay less in taxes than the average worker diligently punching the clock every day? It's a question that has likely crossed your mind, especially when tax season rolls around. It's not some kind of magic trick or secret handshake with the IRS, it's a carefully constructed strategy, a well-thought-out plan that leverages the existing tax laws to their advantage. And today, I'm pulling back the curtain, revealing exactly how they do it. All completely legally, above board, and within the confines of the tax code. We're going to explore the key strategies that the wealthy employ to minimize their tax burden and maximize their wealth accumulation. One of the fundamental differences lies in how the wealthy generate their income. The wealthy rarely rely on earned income, that is, a traditional salary or wages. Instead, they strategically generate the vast majority of their wealth from investments. A diversified portfolio of assets that work for them, even while they sleep. This includes stocks, carefully selected for long-term growth and dividend potential, real estate, both residential and commercial, offering opportunities for appreciation and rental income, and business ownership, where they can control the flow of income and expenses, and reinvest profits for further growth. Why is this significant? Because capital gains, the profits earned from selling these investments, are taxed at a much lower rate, often just 15% to 20%, depending on your income bracket and the holding period of the asset, compared to earned income, which, depending on your tax bracket, can be taxed at rates as high as 37%. This disparity in tax rates is a cornerstone of wealth accumulation for the affluent. Let me break it down with a simple example to illustrate the power of this difference. A salaried employee diligently working and making $100,000 a year may find themselves paying approximately $24,000 or more in federal income tax. Meanwhile, a savvy millionaire making that same $100,000 but deriving it from long-term investments might only pay around $15,000 in taxes, or even potentially less, depending on their specific circumstances and deductions. That's a huge difference, a substantial amount of money that can be reinvested, compounded, and used to further grow their wealth. But the tax advantages don't stop there. Rich people don't always pay taxes as individuals, subject to the standard individual income tax rates. They strategically utilize business entities, like limited liability companies, LLCs, or S corporations, to structure their financial affairs. These business structures allow them to write off a wide range of expenses as business-related, including meals with clients, business travel, vehicles used for business purposes, and even a portion of their home if they use it as a dedicated office space. The result of these deductions? Their taxable income plummets significantly, leading to a lower overall tax bill. Let's illustrate this with a practical example to highlight the difference. If you, as an individual, buy a car for personal use, you get absolutely no tax deduction. It's considered a personal expense. But a wealthy person, operating through their business, buys that same car and can deduct a portion of the vehicle's expenses, including mileage, gas, maintenance, and even depreciation over the car's lifespan. That's money straight back in their pocket, a tax benefit that significantly reduces their overall tax liability. Selling an asset like stocks or real estate typically triggers capital gains taxes, which can eat into your profits. But the rich often avoid selling their assets altogether. Instead, they strategically borrow against their assets, using them as collateral for loans. This sophisticated strategy is often referred to as the buy, borrow, die strategy, and it's a cornerstone of wealth preservation. Let's say, for example, that you own $5 million worth of Amazon stock, a significant and valuable asset. Instead of selling a portion of that stock and triggering capital gains taxes, you borrow $2 million against it from a bank or financial institution at, let's say, a 3% interest rate. Now you have $2 million in cash to spend or invest as you please. You retain ownership of your valuable Amazon stock, and crucially, you pay absolutely no capital gains tax on the borrowed amount. That's a prime example of how the wealthy strategically leverage their assets to maintain and grow their wealth while minimizing their tax burden. When it comes to tax-advantaged wealth building, real estate is often considered the holy grail, the ultimate asset class for minimizing taxes and maximizing returns. Why is real estate so advantageous? The answer can be summed up in one word: depreciation. Even if your rental property is generating a healthy stream of income, the IRS allows you to depreciate the property's value over time, essentially allowing you to pretend that it's losing value every year, which in turn significantly reduces your taxable income. For example, a $500,000 residential rental property can typically be depreciated by approximately $18,000 per year, according to IRS guidelines. That $18,000 depreciation expense lowers your taxable rental income, even if your property is cash flowing like crazy and generating substantial profits. That's a true win-win situation for real estate investors. To avoid the burden of massive estate taxes upon their passing, the wealthy strategically utilize trusts, sophisticated legal instruments designed to protect their assets. These trusts help them pass down assets to their heirs tax-free or significantly reduce the taxable estate, ensuring the preservation of wealth across multiple generations. One particularly effective tool is a grantor retained annuity trust, or GRAT, which is a common strategy used to pass appreciating assets to heirs without triggering the often substantial gift tax. That's how true legacy wealth gets built, how family dynasties are established and maintained over generations. The IRS tax code is incredibly complex and full of credits, deductions, and incentives, if you know precisely where to look and how to qualify. And the rich? They don't leave this to chance. They hire elite certified public accountants, CPAs, and tax professionals to meticulously dig out every possible deduction and legal loophole available to them. Some of the best examples of these tax-saving strategies include research and development, R&D, tax credits for businesses engaged in innovation, opportunity zone investments in economically distressed communities, and the establishment of charitable foundations. These strategies not only significantly reduce taxable income, but they can also enhance their public image and boost their reputation as philanthropists and community supporters. Here's the empowering truth. Anyone, regardless of their current income level, can learn and implement many of these strategies to improve their financial situation. You just need to make a conscious decision to stop thinking like a traditional employee, solely reliant on a paycheck, and start thinking like the wealthy, as a strategic investor and business owner. Taxes are, for most people, their single biggest expense, often exceeding housing, food, and transportation costs combined. Mastering the intricacies of the tax code and implementing these wealth-building strategies is the fastest and most effective way to accumulate significant wealth and achieve lasting financial freedom.